Hi all, I'm going to touch on points to note for options trading. Well, there are more and more retail traders and investors going to option trading because they are being exposed to such new financial instruments. Then again, going to a financial instrument without knowing it is like going for a battle with the idea of losing it. Why? As always, appreciate a like if you like this video and do subscribe to my YouTube channel too. Thanks. Your support will be well appreciated as this will motivate me to produce more videos. So what's options? Options derive their price from underlying instruments which can be stocks, bonds, futures. The most common for retail traders these days are that they are trading options on stocks. There's calls, there's puts. Then again, are you sure you want to deal with options trading? First of all, do you even know there's a pricing model, valuation model for option pricing, which is called Black-Scholes model? You are in a finance background, you will know in school when they teach you the Black-Scholes model, binomial model for pricing options, all different way to look at it, but all based back to fundamentals because that's what professionals will do when they assess the pricing. Is there any distortion in the option price? Then there's a equation that basically covers a few variables that I will touch on subsequent slides. Secondly, do you know there are various option strategy in place? And why do you want to trade option in the first place? To me, options trading requires a good read of the timing as well as the entry and exit points. Here's a quick recap. You have to know how to control your risk per trade before going into any trade. You can look at my position sizing video if you want to know more. So what Black-Scholes pricing model? I wouldn't go into detail. On the left, you'll see an equation where I note C is the call options, N is the normal distribution, S is the underlying stock price, K being the exercise price, R being a risk-free rate, T being the time to expiry, and sigma being the volatility of the underlying instrument, which is in this case when retail traders trade options on stocks is actually the volatility of the underlying stock price. Here's a quick look of Kuaishou tag against that of Hang Seng Tech ETF. Kuaishou tag is in a red color line and Hang Seng Tech ETF is a blue line. You'll see both are down, but Kuaishou tech is actually down a lot more by 69% over the last 6 months, whereas for Hang Seng Tech ETF is down around 30%. It can only shows that Kuaishou tech is high beta, is moving much more than the benchmark index. But is this reflective of volatility, which is the price around its mean price? You have to know the volatility formula, which I won't touch here. Good as it's a good exercise for you to do some research, think through, and have idea what's volatility. The good thing is you look at the left side where Tiger Brokers platform, you get options. They actually have a pricing for it. You actually scroll below on the left side button, you show a price forecast based on various input stock price, what's today's date, and what's the time to expiry for the call options. On top, you see that is dated 21st, which is 2021, November 2 and 29 date. So that's the date. So from today, T, to the expiry date of the call option, there's 1 month to around 21 days. As the call price, let's assume it's around 6.75 Hong Kong dollar. Exercise price is 90 Hong Kong dollar, as can be seen on top. IV being the implied volatility that they use based on the price fluctuations. And what's the valuation? They actually value it given the implied volatility at 7.47, whereas if you actually get at the market price of 6.7, that's considered as spot price is lower than the theoretical price derived by the Black-Scholes model. Then again, there's a lot of implicit assumption like the risk-free rate being involved and whether the assumption for implied volatility is correct or not. Maybe it's implied using the historical and current data. Then again, things change. When you enter into a trade for options, you have to think through what's the time to expiry, what's the exercise price, what's the volatility, and what's the current spot price for the underlying instrument. You can next slide, which is here. When I compress the implied volatility to 37% from just now 73%, the pricing of the call option fell drastically from 7.47 to 2.499 Hong Kong dollar. That's easily 60-70% fall. I wouldn't want to go too complicated on this pricing model because ultimately you have to think through the few factors, which is the volatility, the underlying price, the risk-free rate. And for risk-free rate, the higher the risk-free rate, the call valuation will be higher. But it's having an implied inverse relationship compared to put price. When higher risk-free rate, put price will be lower. This is just a diagram. If you sell a call, what's your profit? The maximum profit is actually the option premium, the call premium that you sell to third party. That's your income. But what's your maximum profit? That's your maximum profit. But the profit formula, you have to assess if the spot price exceed the exercise price. And once this situation where S minus K is greater than the premium price that you collected, you'll be in a loss position. And what if you sell put? Well, as long as exercise price is greater than the spot price, you'll be in a loss situation if that differential is greater than the premium that you collected from selling the put. It's different compared to selling call. You see the diagram is like a mirror image. Think through the assumptions. Is option entry a hedge to you where you have the underlying stock and you decide, okay, I think for instance like Kuaisotech, you think 100 Hong Kong dollar is the price that it will go to, and you decide to actually say, okay, I have the underlying stock, and in the event that it's going up, but I sell a put so that if in the future if it actually goes up but it come down, then I still have the, you buy a put, then you still have protect your profit in a way. But then again, not everyone is suitable because you have, if you don't understand volatility, risk-free rate, and the other assumptions, you end up overpaying. You could be overpaying for volatility like what I showed earlier. And you are hedging, you must also think through how much should you hedge. You hedge half your position, 1/4 your position, or the entire position. Does it make sense? If this is what you are doing, does it make sense just to reduce the position size as a risk management? And if you're selling options to earn premium, how do you protect your downside? Do you have the underlying stock, or do you have the cash to acquire? I think selling puts is one of the strategy that a lot of people have been advocating. But to me, selling puts of good companies is important, something that you are convinced of holding. The question is, when share price tank, is it a reflection of market sentiment, or is it a situation whereby market price is reflective of the underlying problems of the company? So think through all this. I will only be covering option strategies like straddle, butterfly in the future. If there's interest, do comment in my YouTube video channel so that I will see what are the points and content to generate in future. Thank you. As always, this should not be construed as any investment or trading advice. Thank you.